32 tons of silver vanished from London's deepest vaults in 72 hours. No announcements, no explanations, just gone. While markets celebrated another week of stability, something irreversible was already in motion. The London Bullion Market Association doesn't lose track of metal. They don't misplace inventory. They don't make accounting errors of this magnitude. When physical silver disappears this fast from the world's primary settlement hub, it means someone knows something, and they're not waiting for permission. The question isn't who took it. The question is what they're preparing for that requires this much real metal to disappear before anyone notices. 72 hours. That's how long it takes for 32 tons of silver to disappear from the London Bullion Market Association's registered inventory without triggering a single mainstream financial alert. No headlines, no analyst warnings, no emergency meetings, just silence. The London Bullion Market Association doesn't operate like your local coin shop. Every gram that moves through their system is tracked, verified, and settled through mechanisms most people will never see. When metal disappears from LBMA vaults, it doesn't vanish by accident. It moves because someone with institutional access decided it needed to be somewhere else. Fast. 32 tons represents roughly 1 million ounces of physical silver. In a world where most silver trades as paper promises backed by fractional reserves, this volume of actual metal moving in 72 hours suggests something beyond normal market activity. This wasn't profit-taking. This wasn't portfolio rebalancing. This was extraction. But here's what makes this 72-hour window particularly unsettling. The withdrawal coincided with what appeared to be completely normal market conditions. Silver spot price, stable. Futures curves, typical backwardation. ETF flows, nothing unusual. While every visible metric suggested business as usual, someone was quietly pulling physical metal out of the system at a pace that historically precedes supply disruptions. The timing patterns reveal something more disturbing. LBMA inventory data shows these withdrawals didn't happen gradually over weeks or months. They occurred in concentrated bursts during specific trading sessions when attention was focused elsewhere. Almost as if someone understood exactly when these movements would attract the least scrutiny. When institutions move this fast to secure physical silver, they're not responding to market sentiment. They're responding to information. Information about supply chains that haven't broken yet. Information about demand that hasn't materialized yet. Information about monetary policies that haven't been announced yet. The 72-hour window wasn't just about moving metal. It was about positioning before something becomes impossible to position for. And if 32 tons can disappear this quietly from the world's most transparent bullion market, the question isn't what happened to the silver. The question is, what else is being moved right now that we won't discover until it is too late to matter? Silver doesn't vanish. It gets relocated. When 32 tons of registered LBMA silver disappears in 72 hours, someone made a decision that physical possession was worth more than paper claims. But understanding why requires recognizing what silver represents in the broader financial architecture. Industrial demand consumes roughly 85% of annual silver production. Electronics, solar panels, medical devices, water purification systems. Unlike gold, which sits in vaults generating no utility beyond store value, silver gets consumed in processes that define modern technological civilization. When silver becomes unavailable, production lines stop. But the LBMA withdrawal pattern suggests something beyond industrial hoarding. The tonnage moved represents approximately 4 days of global silver mining production. No single industrial player needs 4 days' worth of planetary silver output delivered immediately. This volume indicates either multiple coordinated buyers or a single entity preparing for extended supply disruption. Here's what disappears without warning in precious metals markets: the gap between paper promises and physical availability. Most silver trading occurs through futures contracts, ETFs, and unallocated accounts, where investors own claims to metal that may not exist in the quantities promised. The LBMA system operates on fractional reserves, meaning multiple parties can hold claims against the same physical silver. This works perfectly until someone demands actual delivery. The 32-ton withdrawal represents conversion from paper claims to physical possession. Someone decided that owning silver on paper was no longer sufficient. They needed control over actual metal stored in locations they control, accessible without counterparty dependency. This conversion pattern historically occurs before monetary debasement events, supply chain disruptions, or geopolitical developments that make physical assets more valuable than financial claims. The entities capable of moving 32 tons through LBMA channels don't make these conversions based on speculation. They make them based on intelligence. Intelligence about central bank policies that haven't been announced. Intelligence about mining operations that haven't reported problems. Intelligence about industrial demand that hasn't been revealed. Intelligence about monetary system stress tests that haven't been disclosed. When you control the information flow, you move first. When you move first, you secure physical assets before scarcity becomes apparent to everyone else. The most unsettling aspect of the 72-hour withdrawal isn't the speed, it's the silence. No market disruption, no price volatility, no supply concerns expressed publicly. The metal simply moved from registered inventory to private control as if nothing significant had occurred. But something had occurred. The conversion from paper promises to physical reality. And once this conversion begins at institutional scale, it doesn't reverse until the underlying crisis resolves. London isn't just another silver market. It's the settlement mechanism for planetary precious metals trading. The London Bullion Market Association controls the infrastructure through which most global silver transactions clear. When banks trade silver with each other, when ETFs claim to hold physical backing, when industrial companies secure supply contracts, these arrangements ultimately trace back to LBMA's vaulting and settlement network. This centralization creates what financial engineers call a single point of failure. If London's silver market experiences stress, the entire global silver trade experiences stress. There's no backup system, no alternative settlement mechanism, no redundant infrastructure. The LBMA is precious metals plumbing for the world economy. The 32-ton withdrawal represents roughly 2% of total LBMA registered silver inventory. In normal markets, 2% fluctuations barely register as statistical noise, but silver markets aren't normal. They operate on fractional reserves where small physical movements can expose massive paper overhang. Here's the London problem. The same silver backing multiple financial instruments simultaneously. A single bar in an LBMA vault might serve as collateral for a bank's balance sheet, backing for an ETF's claims to investors, and settlement asset for futures contracts. This arrangement works efficiently until someone demands that specific bar be delivered to their private vault. Suddenly, multiple claims compete for the same physical asset. The withdrawal pattern from London suggests this competition has begun. When institutions start pulling physical silver from the LBMA system, they're essentially removing collateral from multiple layers of financial products simultaneously. Each ton withdrawn reduces the backing for ETF shares, bank lending ratios, and future settlement capacity. The system becomes progressively more fragile with each physical delivery. But fragility isn't the primary concern. The primary concern is velocity. Once institutional withdrawals begin, they tend to accelerate. The first movers secure metal at current prices with normal settlement timeframes. As inventory decreases and more institutions realize the situation, delivery delays increase and premiums rise. Eventually, the system reaches a point where new withdrawal requests cannot be satisfied. The 72-hour time frame suggests someone anticipated this acceleration. They moved quickly to secure position before delivery capacity became constrained. They understood that waiting would mean waiting too long. London's silver inventory doesn't exist to serve speculative trading. It exists to maintain confidence in the paper silver market. When confidence erodes, everyone wants physical delivery simultaneously. When everyone wants physical delivery simultaneously, the system discovers how much real metal actually backs the paper promises. Historical precedent suggests this discovery process doesn't conclude with orderly market adjustments. It concludes with market structure breakdown. The 32 tons didn't disappear from London. They escaped from London before London became a problem. Every silver market operates on a fundamental deception that paper claims represent real metal. The London Bullion Market Association processes roughly 100 times more silver in paper trades than exists in their physical vaults. Futures exchanges settle contracts worth billions of dollars against metal inventories measured in millions. ETF funds collect management fees on silver they describe as physically backed, while holding warehouse receipts instead of bars. The system functions perfectly until someone insists on converting paper into metal. The 32-ton LBMA withdrawal represents exactly this conversion. Someone decided that owning claims to silver was insufficient. They needed control over actual bars, stored in locations they specify, accessible without counterparty dependency. They moved from financial exposure to physical possession. But here's what makes this conversion particularly dangerous. It reveals the gap between what's promised and what's available. When paper silver trades at spot price, markets assume infinite liquidity between financial instruments and physical metal. Investors believe they can convert ETF shares to real silver, futures contracts to actual delivery, bank certificates to vault storage. The 32-ton withdrawal suggests this assumption breaks down under stress. The mathematical reality is unavoidable. If even 10% of paper silver holders demanded physical delivery simultaneously, the entire system would collapse within weeks. There simply isn't enough real metal to satisfy the claims that have been sold. Industrial silver users understand this reality. They maintain strategic inventories precisely because paper markets cannot guarantee physical availability when supply chains break down. The entities withdrawing 32 tons from LBMA aren't speculating on silver prices. They're preparing for supply disruption. Supply disruption that makes physical possession exponentially more valuable than paper promises. The conversion from paper to physical creates a feedback loop that accelerates inventory depletion. As word spreads about LBMA withdrawals, more institutions demand delivery. As delivery requests increase, premiums rise and wait times extend. As delays become apparent, panic conversions begin. Eventually, the paper markets continue trading while physical markets shut down entirely. Futures exchanges settle contracts in cash. ETFs suspend redemptions. Banks offer financial alternatives instead of metal delivery. The paper system persists, but it no longer connects to physical reality. The 32-ton withdrawal indicates this disconnection has already begun. Someone with institutional access recognized that paper claims were becoming worthless and moved to secure real metal before the window closed. Physical reality doesn't negotiate with financial instruments. When 32 tons disappears in 72 hours, it's not coming back to support paper promises. It's gone forever from the fractional reserve system that depends on it never leaving. Large-scale metal movements follow protocols designed to avoid market disruption. The LBMA withdrawal of 32 tons didn't happen through random transactions scattered across multiple trading sessions. It followed a systematic extraction pattern that suggests institutional coordination and advanced planning. Someone understood exactly how to remove maximum metal with minimum market impact. These withdrawal protocols exist because precious metals markets are psychologically fragile. If investors realize how little physical metal actually backs the paper trading system, panic conversions from financial instruments to real metal would collapse the entire structure. Therefore, large withdrawals must occur silently. The silence requirement explains the 72-hour time frame. Moving 32 tons through normal retail channels would take months and create obvious price distortions. Moving it through industrial supply contracts would trigger reporting requirements and regulatory scrutiny. Moving it through emergency central bank facilities would signal monetary crisis. But moving it through LBMA's institutional settlement network during routine trading sessions creates no visible market signature. The withdrawal pattern suggests someone with advanced knowledge of upcoming supply constraints. They didn't move metal because they thought silver prices would rise. They moved metal because they knew physical availability would disappear. This knowledge differential is what separates institutional players from retail investors. Retail investors respond to price signals after events become public. Institutional players position before events become inevitable. The entities capable of withdrawing 32 tons from LBMA vaults have access to information flows that never reach public markets. Central bank communications before policy announcements, mining company production data before quarterly reports, industrial demand projections before supply contracts get negotiated, geopolitical intelligence before tensions escalate. They move metal when they know. Everyone else moves metal when they discover. The silent withdrawal protocol ensures that by the time discovery occurs, repositioning becomes impossible. The institutional players have already secured their physical positions. The retail market gets left holding paper promises backed by metal that no longer exists in accessible form. But the protocol also reveals timing. Large institutional withdrawals don't happen randomly. They happen before catalytic events that make physical possession dramatically more valuable than paper exposure. Events like currency debasement announcements, events like supply chain disruption reports, events like industrial demand surges that consume available inventory faster than mining can replace it. The 32-ton withdrawal occurred during a period when visible markets showed no stress signals, no volatility spikes, no unusual trading volumes, no analyst warnings about supply constraints. Perfect market calm. Perfect market calm maintained by institutional players removing physical assets, while retail markets remained unaware of the extraction process. The silence wasn't accidental. It was engineered to provide maximum extraction window before awareness triggers competing demand for remaining inventory. Institutional money doesn't move like retail money. It moves with purpose, precision, and advanced intelligence. The 32-ton LBMA withdrawal represents institutional velocity, the speed at which large entities convert financial positions to physical assets when they recognize changing fundamentals. This velocity pattern has appeared before major monetary disruptions throughout modern financial history. Before the 1971 gold standard collapse, institutional gold withdrawals from London accelerated for 18 months, while public markets remained stable. Before the 2008 financial crisis, commercial banks increased physical precious metals reserves while selling paper assets to retail investors. Before every currency debasement event, institutional players convert to hard assets. Before policy announcements make conversion expensive, the pattern always follows the same sequence: intelligence, positioning, extraction, announcement, crisis. Institutional players receive intelligence about upcoming policy changes, supply disruptions, or demand shifts before these developments reach public awareness. They use this intelligence window to reposition assets from vulnerable to secure forms. They extract maximum value from existing positions while opportunities remain available. Then events become public, and repositioning becomes impossible at reasonable cost. The 72-hour withdrawal timeframe suggests the intelligence phase has concluded. Someone knows what's coming, and they've moved to secure physical position before public awareness eliminates the arbitrage opportunity. But institutional velocity creates its own feedback mechanism. When large players begin converting paper silver to physical metal, they reduce system inventory available for future conversions. This reduction makes subsequent conversions more expensive and time-consuming. Eventually, the velocity of institutional extraction exceeds the system's ability to satisfy conversion demand. At this point, paper markets decouple from physical reality entirely. The institutions that moved early secure metal at spot price with normal settlement. The institutions that move later pay premiums and accept delays. The institutions that move too late discover that physical conversion has become unavailable at any price. Retail investors never get the opportunity to convert. By the time retail markets recognize the situation, institutional extraction has depleted available inventory. The 32-ton withdrawal indicates this depletion process has begun at accelerating pace. Institutional velocity patterns don't reverse once triggered. The same intelligence that initiated early positioning continues to drive sustained extraction until physical inventory reaches levels insufficient to support paper market operations. When that threshold gets crossed, silver markets experience what financial engineers call structural breakdown. Paper trading continues, but delivery mechanisms fail. Prices can rise dramatically while physical metal becomes completely unavailable. The velocity pattern from the LBMA withdrawal suggests this breakdown approaches faster than public markets anticipate. Institutional players don't withdraw 32 tons in 72 hours, unless they expect conversion opportunities to disappear entirely. Scarcity doesn't happen naturally in silver markets. It gets engineered. The 32-ton LBMA withdrawal represents more than institutional repositioning. It represents activation of artificial scarcity creation through systematic inventory depletion. When large players remove physical metal from accessible markets, they don't just secure their own positions. They make everyone else's positions less secure. This mechanism operates through mathematical inevitability. Silver markets function on fractional reserves, where paper claims exceed physical inventory by ratios approaching 50 to 1. The system remains stable as long as conversion requests remain predictable and manageable. But when institutional players begin large-scale physical extraction, they progressively reduce the metal available to satisfy future conversion demands. Each ton withdrawn makes subsequent withdrawals more disruptive. Each conversion completed makes subsequent conversions more expensive. Each delivery satisfied makes subsequent deliveries less certain. The scarcity creation mechanism accelerates through competitive psychology. When institutions observe other institutions securing physical metal, they recognize that available inventory diminishes with each successful extraction. This recognition triggers protective positioning where entities seek physical conversion not because they need immediate delivery, but because they anticipate delivery becoming unavailable. The result is inventory depletion that occurs faster than fundamental supply and demand would suggest. But artificial scarcity serves strategic purposes beyond portfolio protection. Entities that control physical silver inventory gain leverage over industrial supply chains that depend on silver availability for production continuity. They can influence pricing for entire sectors by controlling access to essential materials. More significantly, they can benefit from price volatility created by their own extraction activities. The same institutions, withdrawing metal from LBMA vaults, often maintain substantial paper silver positions that profit from price increases caused by physical shortage. They create scarcity through extraction, then profit from scarcity through financial instruments. This mechanism explains why the 32-ton withdrawal occurred during stable market conditions rather than crisis periods. Creating artificial scarcity during calm markets maximizes profit potential when scarcity becomes apparent to other participants. The timing also suggests coordination between multiple institutional players. No single entity needs 32 tons immediately, but multiple entities acting simultaneously can deplete accessible inventory faster than markets can adapt. Coordinated extraction creates cascading effects where initial withdrawals trigger subsequent withdrawals as remaining participants recognize diminishing availability. The scarcity creation mechanism doesn't require conspiracy or collusion. It requires only shared recognition that physical silver represents finite resource, while paper claims represent unlimited liability. When enough institutional players reach this recognition simultaneously, extraction accelerates beyond system capacity. The LBMA withdrawal pattern indicates this recognition has reached critical mass among entities with extraction capability. When precious metal systems approach structural failure, movement follows predictable hierarchy. Central banks and sovereign wealth funds move first. They possess both advanced intelligence about monetary policy changes and infrastructure access that enables large-scale metal movements without market disruption. The 32-ton LBMA withdrawal bears the signature of sovereign-level positioning. Commercial banks move second. They recognize system stress through clearing and settlement operations before stress becomes visible in public markets. Their withdrawal patterns typically follow central bank positioning by weeks or months, suggesting institutional communication that doesn't reach retail awareness. Industrial companies move third. They secure strategic inventory when supply chain intelligence indicates upcoming disruption. Their movements focus on operational continuity rather than financial profit, making them reliable indicators of fundamental shortage rather than speculative positioning. Investment institutions move fourth. Hedge funds, pension funds, and wealth management entities respond to positioning by the first three categories. Their movements often create the price volatility that eventually alerts retail markets to underlying supply stress. Retail investors move last, if they move at all. This hierarchy exists because information flows downward through institutional networks before reaching public markets. Central bank policy discussions influence commercial bank positioning months before policy announcements. Commercial bank positioning influences industrial supply strategies weeks before contract negotiations. Industrial strategies influence investment institution allocation days before retail awareness. The 32-ton withdrawal occurred without retail market participation or awareness. No unusual ETF flows, no significant futures positioning changes, no increased coin shop demand. The extraction happened entirely within institutional channels, suggesting positioning by entities at the top of the movement hierarchy. But institutional hierarchy also reveals timing urgency. When central banks and sovereign funds move physical metal rapidly, they're responding to intelligence about developments that will make such movements impossible or prohibitively expensive. They're not positioning for long-term appreciation, they're positioning before window closure. The 72-hour time frame suggests this window approaches closure faster than institutional hierarchy normally allows. Typically, central bank positioning occurs months before crisis events become apparent. Commercial bank positioning follows weeks later. Industrial positioning develops over additional weeks. Investment institution positioning creates months of progressive market stress before retail panic. But compressed time frames indicate accelerated crisis development. When sovereign-level entities extract 32 tons in 72 hours, they're either responding to crisis events already in motion or preparing for crisis events scheduled to occur within time frames that don't permit gradual positioning. The absence of intermediate institutional movement suggests either information compartmentalization or event timing that bypasses normal hierarchy sequences. Information compartmentalization means only the highest institutional levels possess intelligence about upcoming developments. Event timing means developments will occur too rapidly for hierarchical positioning sequences to complete. Both scenarios indicate systematic breakdown rather than manageable market stress. The entities that moved first secured physical position before system capacity constraints made such movements impossible. Everyone else will discover their paper positions, provide no conversion access when conversion becomes necessary. System breakdown in precious metals markets doesn't happen gradually, it cascades. The 32-ton LBMA withdrawal triggered a sequence of interdependent failures that accelerate beyond management capability. Each component of the silver market system depends on others maintaining function, creating cascade potential when any critical component experiences stress. Cascade initiation begins with inventory depletion. When institutional withdrawals reduce LBMA registered silver below critical thresholds, the fractional reserve system loses capacity to satisfy normal conversion requests. Delivery delays increase from days to weeks to months. Premiums rise from spot plus small markups to spot plus substantial penalties. Delivery system stress triggers financial instrument stress. ETF funds that promise physical backing discover they cannot secure additional metal to satisfy creation requests. Futures exchanges implement delivery restrictions to prevent default on settlement obligations. Banks suspend unallocated account conversions to preserve remaining inventory for priority clients. Financial instrument stress triggers counterparty stress. When ETFs suspend redemptions and futures exchanges restrict delivery, institutional investors recognize that paper silver positions provide no access to physical metal. They begin liquidating financial silver exposures and seeking alternative hard asset positions, further depleting available inventory. Counterparty stress triggers industrial supply stress. Manufacturing companies that depend on silver for production discover that normal supply contracts cannot guarantee delivery. They begin bidding aggressively for remaining accessible inventory, driving premiums beyond levels that financial markets can arbitrage. Industrial supply stress triggers price disconnect. Physical silver premiums separate from paper silver pricing as industrial demand competes for diminishing inventory while financial markets continue trading based on fractional reserve assumptions. Eventually, paper prices become irrelevant to physical availability. Price disconnect triggers system abandonment. When paper silver pricing no longer reflects physical silver accessibility, market participants abandon financial instruments entirely. Trading volumes collapse, liquidity disappears, price discovery mechanisms fail. The cascade sequence compressed into the 72-hour withdrawal pattern suggests artificial acceleration of natural breakdown processes. Someone understood that waiting for gradual cascade development would eliminate positioning opportunities. They triggered inventory depletion deliberately to initiate cascade sequences while they maintained extraction capability. But cascade progression follows mathematical inevitability once initiated. Each stage creates conditions that make subsequent stages unavoidable. Inventory depletion must trigger delivery system stress. Delivery system stress must trigger financial instrument stress. The progression cannot be interrupted or reversed once critical thresholds get crossed. The LBMA withdrawal crossed these thresholds deliberately. Cascade completion results in permanent market structure change. Physical silver markets operate separately from financial silver markets. Industrial supply chains develop alternative sourcing mechanisms. Investment demand shifts to different asset classes. The silver market that existed before the cascade cannot be reconstructed because the inventory that supported it no longer exists in accessible form. The 32 tons, withdrawn in 72 hours, initiated an unavoidable progression toward permanent market restructuring. When the last deliverable silver bar leaves LBMA vaults, something irreversible concludes. The 32-ton withdrawal represents more than institutional repositioning or market manipulation. It represents transition from abundance-based pricing to scarcity-based allocation. After the last delivery, silver markets don't recover to previous function. They evolve to completely different operational structures. Post-delivery silver markets operate through industrial rationing rather than financial trading. Manufacturing companies that require silver for production negotiate directly with mining operations and recycling facilities. Supply contracts specify physical delivery locations and timing rather than financial settlement terms. Price discovery occurs through bilateral negotiation rather than exchange trading. Investment demand redirects to alternative hard assets because silver becomes inaccessible to financial market participants. The paper silver market continues existing, but it decouples permanently from physical reality. ETF shares trade as financial instruments with no metal backing. Futures contracts settle exclusively in cash. Bank certificates represent claims against assets that cannot be delivered. Financial silver pricing becomes irrelevant to industrial silver allocation. This disconnection creates permanent arbitrage opportunities for entities that secured physical position before delivery systems failed. They control essential industrial materials while maintaining financial market exposure through paper instruments that trade at discounts to physical value. But post-delivery market structure serves broader monetary system purposes. When physical silver becomes inaccessible to retail investors and small institutions, it eliminates alternative store of value competition with fiat currencies. Central banks maintain monetary policy control because precious metals markets cannot absorb significant capital flight during currency debasement periods. The elimination of accessible precious metals markets reduces systemic threats to monetary authority. Industrial silver allocation continues through mechanisms controlled by the same institutional networks that extracted inventory from public markets. Supply chain control becomes extension of monetary policy implementation. The 32-ton withdrawal initiated this transition during optimal timing conditions. Extraction occurred before alternative supply sources could be developed, before industrial companies could establish direct mining relationships, before investment markets could create substitute silver access mechanisms, before regulatory authorities could implement protective measures. After the last delivery, these alternatives become impossible to develop because accessible inventory no longer exists to support market development. The entities that secured position during the 72-hour window control both physical supply and financial market structure in post-delivery silver markets. They determine industrial allocation priorities, they influence pricing mechanisms, they benefit from permanent scarcity premiums, they maintain leverage over supply chain participants and investment market alternatives. The LBMA withdrawal didn't just remove 32 tons from accessible markets. It removed the foundation that supported accessible silver markets entirely. What happens after the last delivery is permanent resource control by entities that moved before movement became impossible.